Good morning, everyone. My name is Pernilla Klein, and I'm Deputy CEO here at SNS. In today's seminar, we'll be listening to John Kay talk about his recent report to the UK government about how we can improve the link between financial markets on the one hand and the drivers for growth and enterprise on the other hand. And he will be commented by Michael Treskov, the chairman of Unilever, and also with Per Fremberg from Alecta and Lena Österberg from Carnegie. Before we start, just a couple of words on why we are all here today. This meeting is the first of 12 seminars in a new initiative that we in SNS, at SNS call SNS Corporate Governance Seminars. And this initiative has been made possible by a number of SNS members, and I know many of you are here in the audience today. With every financial crisis follows a debate about corporate governance, and this financial crisis has been no different. Policymakers around the globe are struggling with looking at corporate governance rules and asking themselves what went wrong and how can we fix it. And there are a number of initiatives and proposals underway at the EU level. And here in Sweden, some argue that these changes could fundamentally challenge the Swedish corporate governance model with strong control owners and strong rights for shareholders. The purpose of SNS Corporate Governance Seminars is to learn more about the link between the corporate governance regime and value creation in companies. And we will be inviting leading academics to share their research, and we will ask leading decision makers to share their views. So today's seminar is the first of 12 seminars that we will hold over the next 3 years. So the fundamental question on how capitalism and free markets can be made to serve the best interest of society, that has always been the key focus here at SNS since our founding in 1948. And there have been countless books and reports published on the topics over the years. And let me just mention one because it just came out in a new edition. And it's a book by the economic historian Hans Sjögren. It's called Sustainable Capitalism, and it's about corporate governance at Astra, Stora Kopparberg, and Swedish Match from 1945 to 1975. And this book describes exactly how the long-term ownership strategy of the Wallenberg family contributed to creating world-leading companies, contributing to jobs and growth in Sweden. So sustainable capitalism, that is exactly what John Kay's brilliant and thought-provoking report is about. John Kay is one of Britain's leading economists. He's a distinguished academic and an advisor to companies and governments around the world, and also known to us all as a columnist of the Financial Times. So it's a great pleasure for us here at SNS to introduce John Kay. Please give him a warm hand.
Thank you, Pernilla, and it's a great pleasure for me to be here with you in Stockholm and in Sweden today. As Pernilla's explained, the reason I'm here, or certainly the subject I'm talking to you about, is the review which over the last year I conducted for the British government of equity markets and long-term decision-making. And that was the subject. And it's quite important to say that that's a subject that was given to me by the British Secretary of State for Business. That is the concern from the beginning, was what was it that the financial system did provide or failed to provide for business in the United Kingdom. That was our focus. And we found out a number of things really quite quickly. One thing that I think is important to say is that as a source of capital for British business, equity markets do not even register on the radar screen of significance. Large companies in Britain and indeed around the world generate from operations more than enough cash for their own needs, both in aggregate and in the vast majority of individual cases. In terms of equity raising from capital markets by established businesses, the overall issues over the last 20 years in the UK has been negative, not positive. That is, more equity has been removed through acquisitions and through share buybacks than has been raised for new activities and investment. The number of initial public offerings by UK-based businesses has been negligible over the last 5 years, and it was not very large over the preceding 5 years. An IPO has ceased to be the normal path of development for the successful small business in the United Kingdom. Equity markets are no longer primary markets. Equity markets, therefore, are secondary markets. They're markets in which trading takes place in existing securities, and equity markets are not a means of getting money into companies. They are actually a means of taking money out, because the relatively few IPOs that exist are in the main directed not towards raising new capital for expansion, but towards providing a liquidity event for early stage investors in businesses. That's an important function, but it's a different function from the traditional one associated with equity markets. So we need to learn right from the beginning, equity markets are essentially secondary markets. And that means that corporate governance is not, as it were, a secondary function of the modern equity market. It is a primary function of the modern equity market. That is essentially what equity markets do. Secondly, and this is a particularly UK observation, ownership of UK shares is extremely fragmented. 50 years ago, most shares in British companies were owned by individuals. That ceased to be true in the 1970s. But if we'd been undertaking our work 20 years ago, we would have found that the main owners of British shares were pension funds and insurance companies. That is no longer true either. The share of equities that have been held by pension funds and insurance companies has fallen by half over the last 20 years, and foreign ownership of UK equities has increased dramatically. The main UK share ownership is very fragmented, but the main players, and I'm using my words carefully at this point, the main players in the equity investment chain today are asset managers, and the largest 6 to 10 asset managers, BlackRock, Legal & General, Fidelity, etc., account for about 40% of all UK share ownership. So UK share ownership is very fragmented. I was asked by the Secretary of State, is there evidence that financial markets lead to more short-term decision-making by UK companies? And I concluded that there was actually quite a lot of such evidence. And I'd point to 3 main groups of problem. One was the tendency for many senior corporate executives, often executives themselves with a financial background, to engage in what I came to think of as meta-fund management. They regard themselves as managers of portfolios of businesses, buying and selling parts of that portfolio in very much the same way as asset managers would manage their portfolio of stocks. What goes on within the operating businesses themselves is a matter of secondary, if in some cases any, interest to them. They see their role as being of acquisition and disposal, essentially. There is meta-fund management of this kind, and the evidence that this activity adds value is, as a matter of fact, as scant as the evidence that active fund management at the investment portfolio level in aggregate adds value. The second is the group of problems associated with earnings management and the role of sell-side analysts. This has reached extreme proportions in the United States, where you have essentially an earnings management routine in which companies center their financial operations around quarterly earnings announcements. What they're trying to do is manipulate the market's expectations of these quarterly earnings announcements in order to, if possible, be marginally ahead of what it is the market expects in these announcements. That means, in turn, that the analyst needs to be close to the company in order to have the information which is needed to keep his clients posted on future earnings announcements. There was an occasion 4 or 5 years ago when I had a research assistant who had worked in an investment bank, and she had been forecasting GDP for that investment bank. And I suddenly realized that she did not actually know what GDP was. And that came as a shock to me for a moment, until I realized that she was not actually trying to forecast what GDP was. What she was trying to forecast was what the Office for National Statistics would announce GDP was. And if I gave her information on what GDP actually was, it was of no real relevance to her activity in the investment bank. The same is true in relation to these activities of short-term earnings management. People are engaged in a self-referential activity, which has become more and more divorced from anything that is going on in the underlying business. So the second group of long-termism problems are those to do with earnings management. The third group of issues are to do with investment in intangibles. We looked at investment in physical items, and there are some problems there. But in one of the characteristics one came to realize of modern business, indeed one of the real reasons equity markets are no longer significant as sources of primary capital, is that for many businesses, primary capital itself is not very important. Traditionally, we thought of the businesses that raised money on the markets as being businesses that would raise large amounts of capital to invest in big manufacturing plants and the like. But modern business very often has no need of substantial or perhaps any amounts of tangible capital of this kind. We can all point to companies, successful modern companies, the Apples and Googles of the world, that became cash generative within a very short time of starting operations. So investment in tangible capital is less important, and the companies that do have large needs for tangible capital, like utilities and oil companies, continue to be able to get it. But investment in intangibles is, I think, a great deal more of a problem. And we were able to document case after case in which companies that generate wildly complex tariff structures or sell inappropriate products to their customers or simply offer their customers worse value for money for a period have been able to drive up short-term earnings at the expense of undermining the long-term competitive capabilities of the business. So these are three areas: meta-fund management, earnings management, and investment in intangibles, in which we found evidence of short-termism and ways in which financial pressures generated from equity markets had led to bad business decision-making. We also observed that the chain of intermediaries, the chain of intermediation between the companies at the one end and the savers whose money it was at the other end, had become immensely long and immensely expensive. When we simply sat down at the beginning to write down all the people who participated in the chain, the nominees, the registrars, the custodians, the asset managers, the fund of fund managers, the investment consultants, the pension fund trustees, the insurance companies, the independent financial advisors, the platforms, each of them part of this aggregate investment chain, with two problems. One was that the existence of all these people added to the aggregate costs of the activity. And the second was the interposition of intermediary after intermediary, each with their own business model, created core misalignments of incentives through the chain between companies at the one end and savers on the other. And for us, the key questions are about companies at one end and savers at the other. It seems obvious, even banal, to say that markets exist ultimately for the benefit of their users, not for the benefit of market participants. But it would be very easy to read what is written and said, and particularly to look into the regulation of financial markets and entirely forget that perspective. The dominant perspective is that of market participants, and the dominant criteria for judging the performance of markets are the perspectives of market participants. One hears endlessly about the merits of liquidity, price discovery, transparency, as though these things were ends in themselves, but they are not ends in themselves. They are only things which are of benefit insofar as they generate benefits either from the performance of the underlying companies or benefits for the savers whose money is invested in equity markets. So our emphatic perspective right from the beginning was one that views the performance of equity markets through the eyes of market users, not through the eyes of market participants. That leads one to perhaps talk about a vision of what a different future, might actually look like. But it leads one also to emphasize two aspects of financial markets. One is the need for trust and confidence. Indeed, trust and confidence are the essence of financial intermediation. The reason we have any intermediaries at all in financial markets is that people can only create diversified, and if people need to create, as they do, diversified and liquid portfolios, they will want to employ intermediaries to generate that liquidity and to manage the problems that arise from the loss of information and control that come from achieving diversification and liquidity. And that's a relationship that requires trust and confidence, both between the intermediary and the company, and between the saver and the intermediary. Now, we've heard a great deal in the last 5 years about trust and confidence in financial markets. But when I hear people in the City of London talk about it, as I do endlessly, they talk about this as if it was a public relations problem. It is not a public relations problem. And the way one restores trust and confidence in the financial system is not by people going around giving lectures about how honest they are. Indeed, I suspect your experience, as mine, is to be deeply suspicious of people who spend any time at all telling you how honest they are, because it's only if there are some doubts about that question that the lecture ever needs to be delivered in the first place. Trust and confidence is the product not of assertions of one's integrity. Trust and confidence is the product of how one behaves. And the reason the trust and confidence in the financial services sector is diminished is the product of the way people in the financial services sector have behaved. And it is not going to change until that behavior changes. Indeed, the prognosis for the short term seems to me, if anything, negative, in the sense that as people find out more, as they are doing, about what has been going on in the financial sector, their trust and confidence will diminish rather than increase. So trust and confidence are vital, but we need to think about trust and confidence in a more critical way. Secondly, incentives matter as well. Now, I know when I talk about incentives in relation to financial services, or indeed almost anything nowadays, people immediately start thinking about bonuses. And I want to say that that's not what I'm talking about, or it's not primarily what I'm talking about. People are, of course, subject to financial incentives. They're also subject to many other incentives as well. The vast majority of people in business, including actually most of the people I interviewed in the asset management sector, primarily want to do a good job. And if they have to, if they are rather well rewarded for doing that job, as in the asset management sector they are, that's something that adds to their satisfaction from it. But in the end, the good job is the motivation of what they want to do. What is key about incentives for me is that my belief that people typically act as you would expect them to in the environment in which they find themselves. And once we recognize that, we should understand that the way we get things right in the financial intermediation sector is we create structures that give people opportunity and encouragement to do the right things. We have not succeeded, and we will not succeed in future, in getting the kind of behavior we want in the financial services sector by having inappropriate structures and incentives, and then having detailed regulation that tries to stop people doing the things that they are incentivized to do by existing market structures and practices. Well, that's actually a fundamental shift in the way we think about regulation, but is one that is necessary if we are to make regulation effective. And it's actually for that reason that there is relatively little about regulation in my report. That's actually been probably the most wide criticism of it so far, that I haven't prescribed a lot of detailed regulations as to how to create the world I want. But actually, I don't believe the world I want, which is based on simpler structures of financial intermediation rooted in trust and confidence, is one that is capable of being created by regulation, although regulation can get in the way, and I think it does. What does that world I want look like? It looks, it's a world in which the role of the asset manager is central, and we recognize that. And the asset manager is essentially the only intermediary we need. We need someone who enjoys the trust and confidence of savers, and we need to be able to say to savers that not only is it all right for you to be able to say to an asset manager, here is my money, go away for 3 or 5 years and come back and tell me how you've done, but it is actually desirable, if we're to have good quality of asset management, that people should do that and should have confidence when they do that. That's very different from the way asset management activity is governed today. So we need to have relationships of trust and confidence between the saver and the asset manager, and we similarly need to have relationships of trust and confidence between the asset manager and the company in which they invest. That means an engagement of the asset manager with the corporate governance of the company, but an engagement which has a positive aspect to it rather than a negative aspect. Much of what, certainly in Britain today, is treated as the corporate governance agenda is essentially a negative agenda. It is seeing how long the non-executive directors have been on the board and whether they are genuinely independent of the company, right? It's about the relationship between the chairman and the company and so on. It's a negative agenda. It's a box-ticking agenda of saying, if you are doing this or this or this, we want you to stop. Right? What I would like to see is the positive side of corporate governance, in which typically the asset manager is supportive of the company. That's why he is invested in the company. But equally, when he is unhappy with what is going on in the company, his first reaction, at least, is to go and talk to the company about it and try and effect change within the company itself, rather than simply to dump the shares in the company concerned. One of the issues we looked at somewhat carefully in our analysis for the report was one of the worst problems of corporate mismanagement and corporate governance in the UK of the last decade, what happened at Royal Bank of Scotland. And when one talked to fund asset managers and asked them why in 2006, 2007, did you not, when many of them were clearly unhappy about what was going on in that business, why did they not do anything about it? Their reaction was to say the important thing for us was to be less overweight in Royal Bank of Scotland than our competitors were. And that's the structure that the existing nature of the asset management business generates. What we look for then is a world in which asset managers have less longer-term portfolios, less diversified portfolios, portfolios that are more differentiated from each other, in which many of the other intermediaries I have described, people like the sell-side analysts and the investment consultants, largely disappear from the scene. A chain, an investment chain that is shorter and more effective than the one which has grown up over the last decade. It's quite a big change from the world which we are in today, but it's the world to which you are driven if you take this fundamental point that equity markets exist not for the benefit of participants in equity markets, but for the benefits of companies in which investment takes place and the savers who rely for their pensions and other long-term goals on the success of these individual companies. Thank you.
John, in your report you have a couple of graphs that are illustrating how the UK appears to be performing poorly when it comes to business investment and business R&D. And so we made the exercise of actually adding Sweden to this graph. And here is business investment as a percentage of GDP, and the Sweden is the red line, and it's actually over, and here we have the UK at the bottom, and then Germany here, US here. And the same pattern for R&D investment, actually, though the trend is going down, but Sweden is performing better. So is there something to learn here from the Swedish? I mean, you're saying that this is actually, why UK is doing poorly is because of the short-termist bug that you have and the governance regime in the UK. And apparently Sweden is doing better. Is there anything to learn from the Swedish corporate governance model?
Well, maybe there is, and certainly perhaps I should have put Sweden and looked at the figures for Sweden when we drew these graphs in the first place, especially since in our discussions we saw Sweden as I described how the UK was at one end of the spectrum in terms of the fragmentation of asset holding and asset ownership in equity markets. Sweden is, in a sense, as the opposite end in exemplifying a continental European tradition of large block shareholdings in individual companies. And these kind of figures certainly support the idea that that structure is more conducive to long-term investment. I think we have to be. These kind of graphs are suggestive, however, but I think we have to be careful about attaching too much significance to them. In a sense, they often reflect the sectors in which particular economies tend to be specialized, rather than holding up in comparisons of particular companies and particular industries in these sectors.
Professor Kay, you talk about incentives for long-term ownership. And clearly differentiated voting rights is one regime where you get incentives for long-term ownership, but you choose not to prescribe that route for the UK. Why?
Well, it's perhaps an exaggeration to say we didn't prescribe it. In our interim report, we made the point that the reason these things don't exist in the UK is not because of any UK regulations or laws that would prohibit them. It's because of the long-term hostility of UK institutions to companies having differentiated share classes. And it must be said, while we've been doing this exercise, the fact that News International is one of the very few companies that does have different classes of share ownership has not been helpful for those of us who would like to encourage British institutions to take a different view. It became clear in the discussions we held that British institutions were not yet ready to reduce that hostility. So all we did in the final report was to say we should keep thinking about this issue, and I hope we will, and they will. I think it would certainly be interesting if some British companies would think about instituting differential share classes in ways that would drive home to these institutions that in Britain today the likely holders of these different kinds of long-term shares would actually be large investment institutions rather than, as they traditionally were, cranky old men like the Watners who held shares in the Savoy, the Connaught and Claridge's for decades, and actually succeeded in preserving them as quite remarkable hotels over that period as a result. But that's another story.
Professor Kay, you call for financial markets to be based on relationships of trust. And the question is obviously if this is realistic in today's globalized markets and fast-moving markets that we have. But as I read your report, you're really saying that there are advantages of the markets that we have outside the public markets, private equity, private debt finance. Is that the solution then, to have more transaction taking place in the private markets?
I mean, it's in a sense both the problem and the solution. One of the reasons so many mechanisms have grown up outside public markets is the problems that exist in public markets. So it's a result of the problems, and that's particularly true in relation to small and medium-sized companies, for whom very few of whom today see public markets as relevant to their growth and development. And I feel entirely comfortable with the development of these other methods of financing, although one's bound to be concerned, firstly, at the costs that are imposed by most private equity structures as they exist today, and also by the short-termism of groups of private equity holders who are concerned, even more than public markets, to drive up earnings in the short run so they can exit in some relatively short period of time, from the investments that they take.
One point that you make is that with every crisis comes a wave of transparency demands. More information is always the solution. And you're saying the result is too much information, too much noise. And you're saying also that the advantage of the private equity model is that the information given is user-driven. What do you mean by that?
User-driven means that it exists because the people who receive the information want it, rather than because some regulatory regime has prescribed, that it ought to be issued. And I think you're right that we've had a philosophical view for 2 or 3 decades that the answer to almost any problem in the functioning of markets is the provision of more information. And it isn't, actually. There is what we economists call information asymmetry, a world in which the seller knows more about the product than the buyer does, across a whole range of markets in modern economies. And the normal way of dealing with it is through the formation of trust relationships. When people go to their doctors, they typically don't want to be read long extracts from medical books on the alternative courses of treatment available to them and the risks and returns involved in each of them. What most people do are increasingly subjected to that because the same drivers of regulation have been present in that market too. But at the end of the spiel, most people say, "Doctor, tell me what to do," or "Doctor, what would you do if you were me?" And that's how people want things to work, and it's why they employ intermediaries in the first place. You know, if I knew the answer to these questions, I wouldn't go to the doctor.
So actually here in the audience, we have with us the head of investor relations at SEB. And you've been a company, Ulf Grunnesjö, and you've been a company that you've been subject to increased demands for more information to your shareholders. Comment?
Thank you. I guess it's an unfortunate consequence of lack of trust, and you're trying to replace trust and confidence by producing more and more information, and it may not actually help the situation very much. It's of course very important to sort of portray the feeling that you are very open and credible, and what you want to do is create credibility with the management, and the company is driving in the right direction, handling the different problems and so on. But when you have to produce that in different reports, it gets complicated. On the other side, you have the other problem, which is sharing our information to the markets at the same time. And in case you met with each and every investor and talked about your problems and so on, you may end up with the risk that you're having information that is geared towards some investors and not shared with everyone, and you could get problems in terms of share price and so on with lack of the breadth of information to the market at the same time. So it is complicated, I must say, but we have chosen to be very transparent with our reports, and I think it helped us through the crisis. We opened up a lot about our investment books in the US and so on when we had the subprime issues and so on. So I think it helped us, but it's complicated because you have, in our case, around 300,000 shareholders that you have to give the information at the same time, and you can't meet all of them.
I think there's an issue being raised there that I think is quite important. A few months ago, a friend of mine was chairman of a small British company who had an annual presentation for his major shareholders, asked me if I'd go along and talk to this group. And I went along, and I started by saying, you know, what are you guys doing here? You know, if you get any information as a result of attending this meeting that isn't available to shareholders at large, you won't be allowed to act on it. And if the chairman or his other directors gives you any information which he hasn't made available publicly, which is relevant to the price of the security, he would immediately have to disclose it to all his shareholders. So why have you come across London to attend this meeting? And there's a basic humbug here, you know, in what we're doing and we're saying. It's perfectly obvious, if you think about it even for a moment, that if you were to take seriously the idea that everyone who is a shareholder in a company ought to have the same amount of information about a company, that amount of information would be close to zero, right? And it's just a pretense. What we are doing, actually, is we are confusing two things. You know, one is we are confusing the case of the fraudster, the person who sits through a board meeting of Goldman Sachs, and the moment the board meeting ends, is on the phone to his hedge fund manager friends to tell them that Warren Buffett is going to take a large stake in the company. And that kind of person ought to be in jail. And we are in Europe very bad at putting these people in jail. The number of people who behave like that in Europe who have gone to jail is vanishingly small, right? What we are instead very good at in Europe is actually developing complex regulations, incomprehensible regulations, actually, that govern the relationships between asset managers and the companies in which they invest. And I think we need to rethink that. And ask indeed what is going on that has led us to drive regulation in this particular way. Because in truth, in Europe, insider trading is a problem, but it is not a problem which is being solved by the regulations that are being introduced in order to enforce it. It's a problem of enforcement, not a problem of inadequate regulation.
Okay, it's time to move on. Thank you very much, John. And it's time Please have a seat, and now it's time to listen to our commentators. And first in line is Michael Treskov, Chairman of Unilever, please.
Thank you for the presentation, and it was great fun to read the report. In that sense that 40 years in global business and being fortunate to, in most cases, work with long-term big shareholders. And that has probably been my luxury and fortunate in that sense that most relations and discussions has always been with long-term shareholders in those companies. I would say I'm spoiled on that sense. On the same time, I would say that I probably made, I don't know how many thousands of roadshows. And when you start to think about those, how much those added value, you can, of course, always be sort of self-critical. I think it's interesting to see the trend over those 40 years, how actually the real market and the expectations market have actually diverged. In that sense, probably when I was young in the 70s and at that time, if I understood anything about the capital market or the equity market, there were probably very much in the same way, which meant that how the company was going, that was reflected rather immediately in the shares. What has actually happened over the years is, of course, that this has been differentiated and diversified fantastically in that sense. And I don't think we in corporate really understand that. We still believe that there is some sort of reflection between how we perform and actually how the share or the market becomes. And I'm happy that actually I tried rather early on to understand that don't try to be part of this expectations game, because there is no win in that one. And I remember at my Electrolux time, we were discussing whether we're going to have a big sign at the entrance of the share price every second, or we should have a sign of how many appliances we were selling every time. And actually, I'm glad that we ended up with every appliances, that we, even if it was a little artificial done. Because I think it's important really to understand that the game of expectations, it's a sort of a betting game. And we corporate executives are not good at that. That's why also in both Ericsson and Unilever, we stopped during my time guidance, because we didn't believe that we probably could actually make a difference or give that type of guidance that the expectations market wanted. If it would have been the real market, what they wanted, that would probably be another story. So we actually stopped the guiding, both at Ericsson and Unilever. And as we will probably talk about later, also at the Unilever, we stopped the interim reporting, financial reporting. I believe it's important for a company to be able to run long term. And I like the John Kay report in that sense, that putting so much stress on this, that we are there for long term. And then you have to make sure that you don't get confused in, and it is as simple as that think about that you have a long-term ambition, like in the Unilever case, to double the business in whatever time. And at the same time, you have ambitions on sustainable development, and you measure that. And then comes the report. And then you believe that you either have lousy figures or you have good figures. And the stock market reacts completely differently. It takes a lot of energy and momentum to be able to explain that for 175,000 employees in the company, what happened. Is there something we don't know? And so in that sense, in order to make sure that you don't lose the energy, and also as a consequence, spend too much on this short period of time. So I truly believe, and I'm happy that John Kay has put so strongly in his report that they want to actually get away with some of the reporting. That doesn't mean that we should not be confronted where we are, which means even if we have a long-term ambition, we need to have checkpoints where we actually have to prove that we are on track. Because as an investor, you need to know whether the company is performing as it on track. But that's not only financial reporting. It is also when it comes to other type of important, like your sustainability performance, etc. I think that is important also to do it. When it comes to a couple of other things in your report, Jan, I would say that I don't really share your discussion on the incentives. In that sense that I share that incentives that it's not only monetary incentives, and I don't think, I'm at no point of the opinion that you work harder by incentives. You want to do a good job. There I do agree. But I don't agree that there is no relation between performance, money, and what gets measured gets done. And if it then gets paid, it gets even better done. And also one needs to understand that it's not only variable pay, it's also variable cost for a company. I think those things one needs to figure out. But I do not believe that it gets people to run faster. So that is not the case. Another part, I have little difficulties in the report because I have to pick some because I like the 97.6% of it. And that is your reasoning about M&A activity, that the government should sort of have an informal over formal view or overview on major acquisitions. Surely when it comes to your antitrust authorities, etc., that's fine. But having some sort of other leisure bodies that will believe that they are knowledgeable enough about acquisitions, I just don't see how that can be handled. At the same time, I understand your point. You want to figure out a way to little reflect and stop and think, so it doesn't just go automatically. And surely, I believe that there are fashions in this. Suddenly when, and of course the pack follows. If an industry starts to give a feeling that it needs restructuring, everybody sort of run at the same targets. And then if you saw the whole pharma industry, that it became a true story that you need to be big, otherwise you had no chance. And of course everybody had to jump then quickly to become big. Whether that was the right decision, I don't know. Many of the acquisitions, as we know, are not productive. But again, I believe that shareholders, and you sitting here, many of you are shareholders and strong shareholders and assets managers, you need to have a say. You need to have a better say. You need to step forward when you don't believe in an acquisition or a transaction, like many other cases. And the worry is, of course, if the equity market becomes so fragmented that no shareholders really feel that they are important and just let it go. I like your thinking there about shareholder forum or whatever. I don't know how that's going to be put together in reality, but some sort, and I think I'm used to that, at least in this home market, that our big Swedish fund managers normally sort of come together and have common opinions on certain important issues. That's not really the case in the Anglo-Saxon world. I think I stop here by not being too flattering and saying I must say, John, it's good reading, and a lot of good feeling when you read it. I'm just in the process of reading another book called Fixing the Game. I don't know if any one of you have read it, but I can really, because that talks about the analogy in expectations market and the real market, how the American football at one time prohibited betting. If you were in the area of, or had anything with football to do, you could not bet. You could take no deals at all. So the expectations market had to live its own life. And I think this is what we have to get used to.
Thank you, Michael. So, Professor Kay, you have a chairman of one of Europe's leading companies saying he agrees with 97.7% of what you're saying. So,
I'll settle for that.
Is that the same reactions that you were getting in the UK?
It's early days for reaction in the UK. I mean, we produced this report at the end of July, and what we were told was the last day we could do it before the Olympics started to hit London. And Britain, as I think in Sweden, is pretty much on holiday when it's not at the Olympics in August. I think most of the reaction I've heard has been positive. I've described already the principal focus of negative reaction, which is to say, why haven't you proposed a raft of regulation, right, which would deal with this? And I've already tried to answer that question. And I've also heard, it's not the first time I've heard Michael's observation, are you saying that the government can make better decisions about long-term mergers and acquisitions than managers of companies have? I think my answer to that in brief would be in general no, but there are some cases which are so bad that almost anyone could make a better decision than the corporate managers are concerned. And if you prompt me, I will give 2 or 3 examples, right, of transactions of that kind.
Is that the chimpanzee's tea party at the zoo who makes it?
Okay, so we're running short of time, so it's time to move on to the panel. I will ask Michael to stand over there, and we will be joined by Per Framberg, the head of asset management at Alecta. And also later, Lena Österberg, you might as well also come up on stage and stand over here. So Per, there are quite a few issues in the K review which addresses the way asset management is being made these days. And K talks about a new model for equity investment with a shorter investment chain where the central figure is the asset manager that has a trust relationship with the company that he or she invests in. And it would be interesting to hear, do you agree with that basic notion, and how does Alecta's asset management model measure up?
Yeah, that's a part where we totally agree, I think, with John. And well, first of all, it requires that you have a rather small portfolio, because it becomes very impractical to have 1,000 companies to have good relations with, or strong relations. And we have a rather concentrated portfolio. We used to have around 1,000 holdings, I think, in our equity portfolio a couple of years ago, and mainly because, of course, index management in some countries. But now we're down to 100 or something. And we really like to be long-term owners, and we believe in a close relation with the company invested in, because we do a very thorough analysis of them. So I mean, we really agree on that.
So, I mean, John can even go so far to say that a good model for asset management is Warren Buffett. Can Alecta become Warren Buffett?
I don't think we will become Warren Buffett or even anything close there, because then you have to have another. You have to work with your own money. We are just people serving the people who have put their money in Alecta. So that's a bit difficult. But his model is certainly a good example, and we have taken a lot of inspiration. We actually have had several seminars working on the Buffett strategy. Unfortunately, not with him present, but anyway. So that's certainly a good start point. It's not the only inspiration source, but it's a very good start when it comes to focus on the businesses rather than the shares, or the stock price movements.
So you're saying that Alecta is basically doing everything that John Kay is asking for.
Yeah.
Is there anything, and you're reading the Kay review, is there anything that you take home with you to say, we could do this better, and there are lessons to be learned?
Oh dear, yeah, I mean, we can definitely always be better, that's for sure. What would I take home as... that was difficult. I haven't prepared that one. No, but I could say some parts where we might not agree totally, and that is on maybe not totally relevant for us, but with this information, there's a whole lot of discussion on what information is relevant, what risk metrics are relevant, and so on. And there I think you shouldn't go as far to... I don't think anyone should decide which metrics to use. I mean, we use the one we believe in, and I think everyone should use what they believe in rather than someone dictating that this is the way to view things. I think one has to be a bit careful when it comes to that.
One point that the K review makes is that asset managers should cooperate to a greater extent. To what extent does Alecta cooperate today in Sweden and with other owners in the international companies that you own?
Yeah, that's a very interesting topic. I mean, as you know, in Sweden we have this, the last 10 years we have had a great tradition of cooperating between institutions, and I'm not aware of the total history that led up to it, but I think if people get dissatisfied with the way things work, you start to cooperate. So that I think was the history, but to have things institutionalized and sort of to require all the time that you cooperate, I think could be dangerous on the other side, because then you form consensus views. So we believe in having our own view first and foremost, because we have our own relations. And then, of course, when you feel that something is wrong, of course you need to cooperate with others. But everyone has to have responsibility of their own views, I think. And sometimes we cooperate maybe too much, or the institutionalize it too much. But we have a great cooperation among Swedish institutions. When it comes to foreign holdings, I would say we have not that much cooperation, or sometimes none at all. And of course, our voice is less heard then. So that's a problem. But it's difficult to have a cooperation with the whole world.
But would you be willing to participate in investors' forum in the UK the way John Kay describes it?
Yeah, it depends on, of course, how many investments you have in various markets, which depends. But in principle, yes. But then it's also a resource question, how much it's time-consuming, for sure. So it's a balance, what we think is the payoff of these activities. But in principle, of course, because it's very difficult to make a difference in these fragmented holdings.
So there's too little time, says the asset manager. John Kay, isn't it? I mean, you're also saying that it doesn't. There's a free rider problem in active corporate governance, because the time and effort you put in, everybody benefits. So if you were an asset manager, would you then be more active than what we hear from Alecta here today?
In that sense, I mean, if I was a Swedish asset manager with less than 1% of the UK market, I would not spend a lot of time, or probably any time, participating in a UK asset managers forum. But that's not what we're talking about. We're talking about the leading asset management firms in the UK market, several of whom are American, that are in fact managed out of London. And we're talking about, well, essentially the number is 2 sovereign wealth funds who are significant shareholders in UK equities. Now, these are the people we're talking about as being the central players in a UK asset managers forum. And one might anticipate that 1 or 2 people from funds like the one we're talking about would from time to time be there as representative of 100 similar funds which also have some share of the UK market. But that's how I would see it and the role there would be for them to play.
Another issue raised in the K review is the regulation of the insurance industry and how that has forced insurance companies to reduce their exposure to equity markets. Is this, I mean, you're affected by the new solvency rules. Has this been good or bad for your savers at Alecta?
I don't know if we have any regulators over here, but I would say it's bad. I'm sure it's a good intention about the regulation, but it certainly hasn't come from our clients. I mean, they wouldn't understand page 1 in these regulations. So it's from our perspective, it's mainly negative because it's focused on short-term solvency rather than long-term consistency, I would say, and that's 2 different things. Not necessarily totally contradictory, but sometimes. So sadly enough, bad for them and us.
So solvency rules are not necessarily good for the savers, and also John Kay also addresses the way that solvency rules look at risk as being 1-year volatility, and it says that's just a reflection of market noise and says really nothing about the underlying riskiness of the asset. Did you agree with that?
Yeah, well, I would put it rather that focusing on short-term solvency, that is focusing on the wrong thing because it can get affected with very short-term, and you have a theoretical valuation of the debt, of the insurance debt, and market prices. Although we wouldn't suggest anything else than using market prices, but they do not necessarily reflect the long-term situation. So that's wrong. But the risk metrics in themselves, given that you have these regulations, I have nothing against. So it's a consistent regulation, but we think it's the wrong one. But that's how I would put it.
And John Kay stresses the importance of asset managers and pension funds to understand their needs, the needs and expectations of their savers. How do you have very many
yes.
end clients at Alecta? How do you communicate with them?
Yeah, I don't think that's our strongest side, and it partly has to do with the way we are set up. I mean, we are a default company for one large pension plan, so we really never meet. Most of our end customers, they don't know that they are customers at Alecta because they get there by default. So it's a very difficult way to communicate. So there we are a special case. It's actually a platform company called Collectum who has that job. So, I mean, we only communicate, or that's the tradition. You give the annual returns. I don't think you have many risk metrics. You produce your solvency measures, but you don't do a whole lot of explanation on what you're doing. But on the other hand, I can tell you there's no one demanding it. We don't get a lot of phone calls on our investment activities. None at all.
So John Kay, what is your recommendation? How should this be done in practice? It sounds very nice and cozy to communicate with your savers, but how is it going to be done in practice? I mean, so many institutions out there with the same setup as Alecta.
No, I mean, my mantra is user-driven information. People get the information they want, and they don't get a lot of information they don't want. And the financial services activity at the moment generates vast amounts of information that people don't want, and isn't read. A very high proportion of the population, including essentially by definition the people who are in the default scheme, do not want to think about financial matters, right? And they will attach no value to routine communications which are sent to them according to some standard regulatory template. To go back to my medical analogy, what people overwhelmingly want when they deal with financial services is to be told what to do by someone they can trust. And that is what is so gravely missing in large areas of the financial services sector at the moment.
Okay, it's time to move on to our next panelist, Lena Österberg, who is one of Sweden's top-ranked analysts. I saw you were in the top 5, the last ranking, and you follow the telecom sector.
I do.
So, question to you as an analyst. The K review calls for less of quarterly reporting, and we just listened to Michael Treskov also talk about a positive experience from Unilever's decision to abandon full quarterly reporting. What's your take on this discussion?
I think, as far as I understand it from Unilever, you still do your quarterly reports, you just don't have the full financial statements and all that. And I think that as long as you provide enough data for the market to follow the long trend, I think you could shorten down the quarterly reports and not issue the full statements. But one has to also understand that the less information a company provides and the longer it is between the reporting periods, I think also the greater the uncertainty around that stock. And I think also that also triggers some short-termism in the market. So as long as you can see that the long-term trend is there, there's enough information for you to follow it, I think it's okay to do sort of a more abbreviated quarterly report.
So Michael, less information, more uncertainty, more volatility. Is that your experience at Unilever?
Well, there are so many other factors in that. I think that the narrative, you need to, of course, communicate with your stockholders or the stakeholders of some sort. And in the interim, we talk about the business products and markets, but not financially. And I think that is the important, because that's checking also the trends, how the business is doing. And I'm not saying that that goes for any business, but ours is a rather steady type of business with very few big trend changes between quarters.
One quote from the K review is that the opportunities created by modern information technology have led many people to overestimate the value of the constant flow of data. And as an analyst, I've been an analyst myself. You live off flow of data. That's your food, more or less. So what's your comment on that? What if there's less information? Would that create problems for you as an analyst?
No, I also have to say that sometimes it's a bit frustrating to sieve through all the information that you have. I guess that the longer you work as an analyst, it's easier to pick the relevant bits and pieces of information. It was rather stressful when I first started out, when every piece of research was new and had to be put in a context. So I think that relevant data is always what's demanded, and that's also what Mr. K stresses, that the demand-driven, user-driven information is what you should have. Do I need the number of minutes used per customer in Moldova by Telia Sonera every quarter? No, I don't, to be honest. I need other bits and pieces of information to be able to assess the long-term trends of the company.
And John Kay also stresses the importance of non-financial narrative reporting, the storytelling bit. Do you agree with that?
Yes, because sometimes I think there is a lot of emphasis put on the numbers and not enough to explain sort of what the numbers really mean. I think that's a factor also, that numbers are easy to put in place and they cannot be misinterpreted. Words are much more difficult and leave the text open to interpretation, and I think that's why we maybe tend to hide behind numbers rather than using words.
Of course, John Kay is quite critical to the way equity analysis and asset management is done today. And so if you were to defend your role in terms of benefits to society, what would you say?
I hope all of you get to answer that question about yourself one day. I think that in addition to the sort of the more obvious answer would be, to ensure that you have efficient capital allocation and to generate better return for my clients. I think that an important role that we analysts fill as well is sort of to review and also monitor the companies that we follow. I think that if I go back, and I think that role is more important today than it was if you go back a few years, because if I look back maybe 10 years, I had specialist counterparties at every fund here in Sweden. There was a specialized buy-side analyst who knew the sector very well and also knew the companies which I follow. But today, I think there's only a handful of those specialist analysts left. And therefore, I think that there is a greater need today than it has been before, so for the specialist knowledge that I hopefully can provide to my clients about the long-term industry trends and also about the companies I follow.
So Per Frambad, do you have your own analyst at Alecta, the way Lena describes it used to work before?
Yeah, we certainly have. We're among the few left with that. And I must also, we do appreciate the intermediaries, although I don't think we use more today than we used to, or it's been a rather flat, but it's mainly for transaction purposes. But I mean, analysts, they feel, I think, a task for us as inspiration and ideas, but we take full responsibility ourselves.
Do you see other asset managers moving in that direction? We just had a debate here 2 weeks ago on the EP funds, and I know that many of them have closed down their active portfolios and are doing more benchmark investment. Yes.
Yeah, well, I think the trend up till now has been, the way Lena describes it, that fewer and fewer have their own analyst teams. But I don't know if that may be reversing. Trends comes and goes. But, the latest trend is fewer.
John Kay, and I know also the Unilever stress in their communication how important sustainability issues are for the long-term value of a company. As an equity analyst, do you actually read sustainability reports?
I do, and I have to say that quality of the reports has improved greatly. They haven't been around that long for the companies I follow, and I would say they have become better and better.
And of course, the telecom sector is strongly influenced by relations with government. There are corruption issues. I mean, how important are ethical and sustainability issues when valuing a company?
Well, they are very important because, actually, if a company makes a decision that's bad for society, you get bad publicity and your brand suffers, and in the end, you sell less products. So I think, sustainability and the long-term value of a company go hand in hand.
So I know that Unilever, you made a declaration to complement your goal of return to shareholders with a goal that you call total return to society, where the needs of citizens and communities are given the same weight as those of shareholders. What's your comment to that, Lena?
Well, I think that's a bold decision, and I think that's very brave. And as I said before, I think that sustainability and the goals of shareholders, they don't have to be conflicting. They could go hand in hand. If Electrolux develops a washing machine that uses half a liter less of water per wash, is that sustainability or is it product development? It's both. If I take Ericsson as an example, a cover, their new base station that they've developed, that consumes between 70 and 40% less power. And by having that product, they managed to break in and regain market share in Europe among the operators in Europe. So that's product development, sustainability, which helped them regain market share.
Okay, thank you, Lena. So John, listening now to the asset manager and the analyst, would we have got the same answers if we were in London right now? If there were a British analyst and a British asset manager?
I don't think we'd have got very different answers, although there is some self-selection, which may be true in Sweden as well, though I suspect less so, of the people who would come along and sit in a platform like this. I described one group of negative reactions to my review. The larger group of people who would take a negative view of the report, I think, are people who would prefer to say nothing about it at all. They would rather, as they make their way to the bank or the private jet or the chauffeur-driven limo, say nothing at all. And that is actually the strategy which they have played publicly with some degree of success since 2007. And one of the things I think we need to do is to engage parts of the financial sector which are engaged essentially in rent seeking at the expense of the rest of the economy, to engage and justify their activities more fully than they have done so far. And that's plainly a larger proportion of the financial sector as it exists today in London than as it exists today in Stockholm.
So Michael, I mean, you travel around and you meet investors, you meet analysts in both London and Stockholm. Do you see that there's a difference in what country you're in, the type of questions you get, and especially when it comes to attention to sustainability issues, long-term value creation?
No, I think it's probably true to say that if I look, and I'm a little biased because I have the most Swedish experience in that sense, and that is that our long-term shareholders, not only the major shareholders, but the long-term shareholders have always been very knowledgeable about the company. And it's very much also been consistent. Many of them have been doing that for many, many years. And in that sense, they know the company well. I think in London, it's probably more focused in fewer that knows sort of, even if they know Unilever, I would say perhaps 2 handfuls or so that are really strong drivers or deep knowledgeable. But if you look at Ericsson in Sweden, it's probably 3 handfuls in that sense. So there's a little different, but also to be mindful about the UK analysts and investors. I mean, they have so much to cover. They have so many options. Here, I mean, everybody, with due respect, had to have Ericsson in their portfolio because otherwise indexes would be screwed up. And that's different in the UK. There are much, much more options in that sense.
So John Kay wants to see more engaged institutional owners, and you talked about before. I mean, with your the control owners being very knowledgeable, having lots of staff to cover the company, and in the situation where institutions would become more involved in having views on the company and being more engaged, do you see that as a positive thing?
Yes, I think I see it. Of course, it depends in what way, etc. But I think the more knowledgeable anyone would be, the more you add in the discussion and in the communication. So I must say we have some extremely knowledgeable analysts when it comes to, if we now talk about Unilever, and add very much value in that communication. And our capital days, which we have once a year for 1.5 days, is extremely useful for the company. It's not only to sort of tell how good we are, but it is really some sort of communication. And I think that's also what John Kay is saying in his report. How can we improve the relations? And that's probably trust and confidence again, how to improve the relations. It's not the matter of trying to sell only the company. It's actually to have a good relation and good communication and good feedback, and actually telling, we don't think this is good, you're not doing a good job here, etc.
Thank you. In the audience today, we also have Albert Kyle, a professor of finance at the University of Maryland. And as an academic studying financial markets, where are you, Albert? I'm right here. There you are. As an academic studying financial markets, what's your take on the K review?
Well, I thought it was. I thought the review was very provocative, but there were also some, and I maybe don't agree with 97% of it, but I do agree with parts of it and disagree with others. But one of the most interesting things to me, and I'm coming from the perspective of a professor who has studied the concept of market efficiency, market liquidity, trading on private information, things like that, for most of my career, is the relationship between the efficient markets hypothesis and what I'll call the market for trust. The report, the way I read it, took the view that traditional proponents of the efficient markets hypothesis kind of think that in addition to getting very accurate prices out of markets, you will also get good corporate governance. And I don't think that's the case. Indeed, there's a voluminous empirical literature that kind of falls under the rubric of the efficient markets hypothesis, which documents what the costs are associated with not having good governance in various circumstances. You know, whether it's fees that mutual funds charge, which I take to be an indication of kind of poor governance with respect to the relationship between the investor and the mutual fund. The performance of closed-end mutual funds, the performance of companies that have good versus bad corporate governance practices. There's a lot of literature that documents the costs and benefits of this, but the literature, and I tried to write a paper on this a long time ago, which tries to show that market efficiency promotes good corporate governance. That didn't get very far. You know, you had the concept of hostile takeovers back in the 1980s, which you might think of as that mechanism, but that mechanism sort of got shut down more by policy and not by academics. So as I think about this, let's think about the market for trust. It would be great if there were more trust in institutions, but trust has two sides. On the one hand, there are the investors who want to have a lot of trust in their asset managers. On the other side, there are asset managers who may or may not be trustworthy. It's a really good outcome if the asset managers are worthy of a lot of trust and the investors actually realize that and trust them a lot. But it's a really bad outcome if the investors trust the asset managers a whole lot more than the asset managers deserve to be trusted. And I think the banking crisis that we had is kind of a result of that. You know, like Alan Greenspan made the famous comment that he kind of trusted the bankers to manage their own affairs efficiently, and they didn't, and created a gigantic mess that the world economy is just now coming out of. So I think the efficient markets hypothesis helps us understand how much trust the investment managers and the corporations are worthy of, and helps us understand how good their corporate governance practices are. So.
Okay, thank you, Albert. So John, what's your comment on the efficient market hypothesis?
I'm not sure that's a question.
Okay,
There's a short answer. But I think, and there are two groups of issue with which we're concerned in any form of financial intermediation, which are essentially how do markets or the institutions of intermediation we set up handle information and the huge information asymmetry that exists between what goes on in the corporation and the information on which investors and ultimate savers are able to act. So there's a group of information problems, and there's a group of principal agent problems which arise from any investment chain. That is, people at each stage of the investment chain have different incentives to each other. And I think I agree with the point that no one has ever really suggested that the efficient markets handle, or the view that efficient markets handle the principal agent problem well is principally based on belief in a market for corporate control, hostile takeovers and the like, that no one takes terribly seriously because the imperfections and the transactions costs in that market are so large that story does not really work. What there has, I think, been a willingness to accept is that efficient markets somehow solve the information or relieve the information asymmetry problem. And I certainly don't believe that. I think that the level of trading activity that has grown up in modern equity markets, for reasons which were described very well by Michael, that people are today in the business not of analysing what is going on in companies, but in analysing other people's expectations about what is going on in companies, which can be extremely divorced from these underlying realities. And that has created what I think we see, which is a set of markets in which there are very high volumes of trading and very little real understanding of what it is determines the long-term value of company securities. Mm.
So in the audience today, we also have another academic, Sophie Nachemson. You've looked at also how the functioning of financial markets. Sophie, what's your take on the K review?
I really enjoyed reading the K review, so that's not a problem. But I think that we have drifted so much in this discussion now towards looking just at the responsibility of the pension funds and institutional investors. What I feel is a worry is that you have a lot of short-termism built into the market today, where in case when you have a takeover or a hostile takeover, you have a lot of arbitrage investment funds that come in and will tipple the decision making, so that the minority owners, which might belong only funds, even British ones, will end up selling anyhow. So the thing you put in with the government's involvement. Couldn't the government be sort of like the last resort that tells the market so to wait a bit, and you cannot make the short-term investment funds arbitrage and tipple, so that the long owners just have to cool down the market?
I can make one comment to that. We got in the course of the review a lot of quite aggressively hostile comment about the activities of arbitrageurs in takeover bids. I must say, I was bound to say that the reason the arbitrageurs in these bids owned the shares was that predominantly British institutions had sold the shares to them. And therefore it seemed to me the issue one should be focusing on is not the role of arbitrageurs, but actually the long-term commitment of UK institutions to UK companies. And I thought the hostility to arbitrageurs was almost a sideshow in which asset managers were to some degree deflecting attention from their own responsibilities and their own inadequacies in discharging them. You know, I would like it to be British institutions who predominantly took the view on whether Kraft taking over Cadbury was a good idea or not. And ultimately it was. But they tried to argue that the responsibility had, by this mysterious mechanism, been taken out of their hands.
We have time for one final comment from the floor before we end, and that is, I would ask, Mats Isaksson is here today, and he's been responsible for a recent report from the OECD called the Corporate Governance, Value Creation and Growth, very much the same topic as the K review. What do you think the K review adds to this important debate?
Well, thank you very much. Maybe I should stand up. Well, first of all, I think we should all remember that this is not Professor K's first work on corporate governance, and even more importantly, I think it's not his first work on market efficiency, one of the most difficult and most misunderstood issues in economic theory and practice, I think. So when I got fed up with this negative agenda, if you want, in corporate governance, which was Professor K referred to, it was very natural for me and a big privilege to have lunch with Professor K in London some 18 months ago or whatever, in preparing a new project in the OECD, which we called, as you said, value creation and growth. And the purpose was obviously to put just as Professor Kay has done, a positive agenda on the table. And I'm glad to say, I suppose, that our project is totally inspired already what Professor Kay learned at that juncture. I think he, in this report, has just written down what he already knew 18 months ago, and what he did in the interim, I don't know. A lot of hard work, obviously. But this was wisdom that inspired our work already then. So we are very grateful. We are working along the same lines. We have only issued so far an exploratory report where we gathered a crowd of mix of academics and practitioners to scope the work that will take place over the coming 2 years. How does it link to the K review? Well, I think the basic question is exactly the same. Going back to basics and try to understand, and as we have as a subtitle, we have, I think, something like bridging the gap between finance and enterprise. The way we differ, I think there are three main areas where we differ, or three aspects where we differ, or complement, I should say. The first is obviously that we take the issue international. So we have the difficult task of raising and asking these questions in different jurisdictions, with different traditions, with different ownership structures, and different players. That's the first question. I think that will only be good, because it will provide, first of all, national policymakers with, hopefully, with some inspiration of how it can be done in other countries. And it could also inspire, or at least inform, those that have supranational ambitions in these areas to regulate one size fits all, that is not necessarily a good idea. And also, as John said the other day, that if you want to regulate across borders, why use the UK model necessarily? The second way that we will complement the report is that we will also engage emerging markets quite heavily. Today, if we look at primary markets, and we've gone through every IPO since 1990, you will see that approximately 70% of all equity raised in the world today is raised by non-OECD companies in non-OECD markets. So this is a place where primary markets at least are active. How efficiently they work is another question. But when you travel, and I'm just back from Asia the day before yesterday or something, they are actually, what they are asking themselves, because they all want to be financial centers, but they ask themselves, how do we avoid the mistakes made, for example, in London? So that's a thrilling and very challenging perspective. And we will be back with a first report sometime in the spring of 2013. Thank you.
Okay, thank you, Mats. Well, time is running out, and I think it's clear from the discussion today that there is a snowball rolling here, and it is growing. The attention around the basic issue on the connection between corporate governance and value creation, the positive approach, and that's very much what our the SNS corporate governance seminars will be about during the next 3 years. So I'd like to say a warm thank you to John Kay and to our excellent panel and to all of you. So just before we end, the next meeting in this lecture series will take place on November 7, and it will be the same time, same place, and we will discuss the topic of how do strong owners design CEO contract, and we'll be listening to Professor Henrik Kronqvist, and hope to see you then.
Kommer det bli bättre nästa år än vi
Ja, tack. Tack, kul att du var här.
Oh, right.